Hi, John here from Red Oak, and welcome to another video in our Tax Essentials series. Following up on our introduction to the P60 video, today we're going to look at how the income tax on your P60 is calculated. Okay, so how is tax calculated? First of all, we need to know the amount of your pay that is chargeable to income tax. Let's take the example of someone who earns $24,000. Here's what their P60 might look like. You'll see in Section A, the $24,000 is what we'll call taxable pay. The next step is to calculate the gross tax charge. In the most basic scenario, you're charged tax at what is known as the standard rate, which in 2014 was 20%. Charging $24,000 at 20% gives us the gross tax charge of $4,800. At this stage, your income tax bill is looking ridiculously high. But that is not your final tax bill. Each and every person gets a range of discounts or vouchers to reduce this gross tax charge. These are called tax credits. And let's use, in this example, a tax credits amount of $3,300, which is the typical starting tax credit for a single person. If you reduce your gross tax charge by the amount of your tax credits, you get your final tax bill or net tax charge. In this case, your net tax charge is the $4,800 less the $3,300, giving $1,500, and this is the amount you were actually charged in your wages. So that is the basic scenario. And I just want to give you one more detail. While many people will only pay tax at the standard rate of 20%, there is a point called the standard rate cutoff point, and any earnings you have above this point will be charged income tax at a higher rate. In 2014, this higher rate was a whopping 41%. The standard rate cutoff point, which for a single person was typically $32,800 in 2014, is stated on your P60. It can be called the rate band, or abbreviated as SRCOP. So, if we take an example of someone who earned $42,800, we will charge $32,800 at 20% and $10,000 at 41%, giving us a gross tax charge of $10,660. Reduce this by the typical tax credits amount of $3,300, you get a final tax charge of $7,360. As you can see from the examples above, two of many ways to reduce your tax bill are to increase your tax credits or increase the rate band amount. If these are done after the end of the year, it typically results in a tax refund. So that is a typical scenario, but does not by all means cover all scenarios. And I hope it was helpful, and thanks for getting this far in the video. Visit redoak.ie to find out more about our tax and payroll services, and do feel free to give us a call. Thank you.